Good morning, colleagues, friends. As always, it's a great pleasure being here this morning. It's great to see a lot of familiar faces, and it's really nice to come and share some thoughts with you. And following up on John and Rob's presentation, I'm a farmer myself, so I think, you know, I really enjoyed your talk and looking at what your proposals are and what we are doing on the farm and trying to do things different. It's really worthwhile and good value. What my purpose is, my job this morning is to try and put the canola industry in what you've seen now in terms of talking about the targeted yields, putting that into perspective of the greater economy within South Africa. Well, let's take agriculture within the economy, and then how does this all fit into the global picture? So these are more of the strategic pitch. I hope I'll succeed in that. I've got literally 3 hats on this morning. Or my fourth is definitely the farmer hat. But I'm the director of the Bureau for Food and Agriculture Policy, and the unit is linked to also, Andries, ons is hier so in Stellenbosch ook, net die vrugte wat hier so getackle word. Maar ons is, we're down here in Stellenbosch, we have a unit, and at University of Pretoria we have a unit, that's where also I'm an associate professor. And then I'm also privileged to be on the PRF board. We also have learned a lot. Okay, so the first graph, and I'll try to be very specific on these slides. I know you sitting at the back, it's not always easy and these things flip through quite a bit. But I just wanted to give you a context of the South African economy and more specifically agriculture. Let's look at the graph on the right-hand side. That's where you have, for the last 4 terms or the quarters, the agriculture sector has actually contracted. We have a negative growth rate. And that's for you here in the Western Cape. On the ander kant van die biltong gordyn, you guys are actually doing much, much better than the rest of the sector is doing in the country and up north. And you're all aware of the drought. This has really hit us hard. And that's the main cause for that negative cycle that we're currently in. We are going to move out of it, and we can see it from the past. There we've had a negative cycle, 2009 and 10, and who can remember what was that caused by? It was a global recession. Okay, so we had the plummeting of international markets there. 2006 and 7. 2007 was a drought. What happened in 2006? Remember, there was this big drive where Grain SA, with the farmers, there was this big drive of planting less. So the maize plantings literally decreased by 40%. So there you can see these cycles moving. So we know there's a combination of macroeconomic cycles. What caused this boom here? Look at this wonderful period and this growth in agriculture. This was basically the commodity super cycle globally, where you had American biofuel policies coming in, overlaid with fast economic growth rate in China. And then on top of that, the US then had a few weather issues. Here in 2012 and 13, we had some very high commodity prices there, oil prices, and then everything started coming down. So it started declining. And that's something that we need to take note of. So globally, a lot of things influencing our agriculture production and our GDP and the way that it drives the economy. More specifically, just something, I think this is maybe not always a well-known fact. We see a lot of maize and we see a lot of wheat and canola, but the largest industry in South African agriculture is actually the livestock industry. And if you can just look at this graph, the blue line on top, that gives you, just look at the relationship there. That's the livestock industry's contribution to agriculture's gross product. And then we've got the fruits and the field crops, and that's where obviously where wheat and canola and barley, the commodities down here lie. It's always in competition between the fruit industry and the field crops, depending on what the season looks like and obviously your exchange rate and that. And these are our latest estimates by BFAP. This is where we're projecting that the field crops in 2015-16 will be well under the value of horticulture. But as we're moving out of the cycle and we get normal weather back on track, the cycle will recover. Grains, summer grains will recover quicker within a season. There are some issues in terms of cash flow, credit applications, where there's some stress, financial stress, but the hectares are going to pick up. Where we will see an extended impact of the drought is in the livestock industry. And this graph just gives you an overview of what has happened to the national cow herd in South Africa. Now you are farmers and you understand what this implies. Less cows, less calves. We're going to go into a herd building phase, and it will take us about 3 to 4 years. So that's also our projection in terms of higher beef prices generally. And you can see there the national cow herd declined by about 15% to 20% in some areas. So we've really slaughtered into our cattle herd, and that's going to have a longer lasting effect on the livestock industry. Poultry and dairy, they'll recover more quick. They'll have a quicker recovery because of lower feed costs as soon as we get into a surplus maize situation again. So that just gives you a bit of an overview. Now let's get more specific in terms of canola. That's what we want to talk about this morning. How did canola perform over the last 4 or 5 years? And this is really a success story and something that we can all be proud of in this room. This graph gives you an overview of, and this is basically the work that we're currently doing for the Ministry of Finance and for the Planning Commission, doing a bit of a review. You all know the National Development Plan that was launched by Trevor Manuel's group. And there we've plotted out, we had a matrix with identifying what are the industries that can grow fast and that can also create labor. Now on this graph, if you look all the way on the left-hand side, canola is the industry that out of all of these industries here, and don't worry about all the detail there, but essentially canola is the industry that grew the fastest out of this whole range of industries. Okay, so yes, it's in relative terms, these blue diamonds give us the share of agriculture produce. So for example, there's beef. Beef expanded by an average of 2% per annum. Okay, and it's got a significant contribution to GDP. Here are your big industries. Poultry didn't grow at all, or very, very little, and has a huge industry. Maize, where's maize? Yellow maize, about a contribution of 6-7% to GDP, and it grew just under 3%. So, but look at canola. It's got a small contribution. It's a smaller industry, but look at its growth rate. Average annual growth rate of about 6% per annum. And where does soybeans lie? Also a nice one for the sake of the PRF, just over 5% growth per annum over the last 4 to 5 years. So we were anticipating that these industries would grow, and they have grown fast, but we still think there could be some faster growth coming, and we need to focus. And these kind of talks that we've had this morning, those are the essential ones, focusing on the detail, getting things right. And these are the messages that we also want to bring across to government, saying where can government do things better, and where are there opportunities to unlock potential, especially if we come to these higher value export commodities like your table grapes, your apples, your citrus. Look how well these industries have also done. They're soft citrus, lemons, and they've expanded, colleagues, about more than 3% per annum. So that's good news, but I think the agriculture sector, if we all work together and get everybody on the right track and have focus more on the detail, we can actually do better. That's the matrix that I was referring to. That's the National Planning Commission's matrix. And there you can see soybean, canola, poultry, eggs, dairy. These are the commodities that we're targeting for high growth. They are obviously not labor-intensive commodities. They're non-labor intensive. And here are more your labor-intensive commodities, your apples and your pears and your citrus. So that just gives you a feel for where does canola fit into the bigger picture, and it really has to fill a very important spot. So thinking about the future then, this is part of the work that we at BFAP do, is constantly trying to think about future scenarios. And I know this is where it becomes always this assumption story. What are the assumptions that you're based on? The importance about the future scenarios that you create a consistent story, a consistent storyline that you say, if these things are going to take place, these will be the potential outcomes. So you're kind of measuring and benchmarking and trying to get an understanding what are the exogenous factors and how will that influence our business. So if we think globally, who are the major producers of canola? If we think about the canola industry and we need to keep our eye on the global picture, who are the major players? The European Union, and I've lumped them all together. This is the production of canola globally, and I've taken it over the last 10 or 15 years, and you can see production has picked up very nicely, growing from just under 40 million tons globally to about 70 million tons globally. So it's gone through a nice trend. What has caused that big growth there in Europe? Any guess there? The biodiesel policy. So again, driven by policies, you create a new demand, and there's a big shift into that oilseed industry. Yes, and we've had a growth in the animal feed market as well. So Europe is a strong player. Who's the second one there? Canada. Then we have China, India, and that blue little section there. Well, it's not that little if you compare it to South Africa, but those are Australian colleagues. Globally, you're on the map. We'll probably just be one line, that size about, globally, but still the big players are around Europe, China, India, and Canada in terms of the global market. So what has happened globally? And this is something that we have to keep in mind, is the exchange rate has really postponed the commodity cycle for us as South African producers quite a bit. So this is what the global picture looks like, and this is for maize, and we'll come to the oilseeds now. Colleagues, the commodity markets in the world are flat. There are major surpluses, stock levels are high, production has completely caught up with consumption. So whereas since we introduced those biofuel policies and we had China growing fast, production has basically responded. We have seen some expansion globally in the area under production. We've seen higher yields, and basically the farmers have caught up. Stock levels are picking up, and this is the type of picture that we're seeing out there. So major decline in prices, almost half of what they used to be 2 or 3 years ago. So agriculture is going through. In South Africa, we haven't seen it for 2 reasons: the exchange rate, and then the summer crop. Also the reason for the drought, moving to a shortfall. This is the global oilseed scenario. So there are 2 things that I want you to pay attention to on this graph. Firstly, yes, prices are much lower. If we look at canola prices globally, just over $600 it peaked in about 2012. We are down to about $400 per ton, global canola prices. So what is this telling you? If you're not the efficiency drive, the productivity drive is absolutely essential for long-term sustainability. If we as South Africans cannot be on that global competitiveness and productivity curve, we're going to fall off the bus, because that's generally what's happening out there. I don't have the graph here, but if you look at it in real terms, the real price for something like wheat or maize over the last 100 years, if you look at this, what we refer to as a super cycle, if you put it on 100 years, it literally makes just a small little blip. Because in real terms, our prices have just consistently come down all the time, thanks to companies like DuPont, Pioneer, and Bayer, and research, and John Deere, and mechanization, and all these things that are constantly driving efficiency. I mean, those graphs that we saw, we want to drive kilograms per millimeter that we receive of rain. The better we get at that. And that's how we drive, and that's why this picture looks like this. So as a farmer, don't expect higher prices in real terms. You have to expect lower prices in real terms. That's the reality. How are you going to beat that? Productivity. That's the only way how. Okay, and the second point that I wanted to make here is, look how close does canola trade to your soybean and your sunflower prices globally. Yes, there are periods where they move apart, but the long-term trend, these are very closely connected. Second graph, which is also important in terms of the economics of oil seeds, and I'm now referring to the oilseed complex, is the vegetable oil market. And this is where South Africa has an interesting dynamics. Can you see that red line or the orange line at the bottom? That's palm oil, the global palm oil price. And that's very important for our local oil, vegetable oil market. Because if you look at numbers, we have rapidly increased our amount of palm oil that we import. And palm oil is coming in at a very competitive rate. And that's also affecting our canola oil and sunflower, mainly sunflower oil, because it's in the commercial use, not in the franchising business, but not really as consumers on the shelf. But it does have an influence on our total vegetable oil market. So it's coming in at a very low and competitive rate, and it's the cheapest oil on the market. Globally, we still have sunflower, soybean, and canola oil also trading relatively in close margins. But you can look at the outlook. That's that section there in grain. This is done by our colleagues in the US. They've projected oil prices over the next 10 years. So surely, this looks like this is not possible. How can you have this much variation in the history and you're projecting a straight line going forward? Well, we've assumed normal weather conditions. As soon as you start to put in those weather conditions, you can get a whole distribution, a stochastic distribution of prices going forward. This is like just the average out of all those different prices. So globally, and this is Erod and I took this picture on our trip that we went to look at the supply chains globally. And we visited the US and Brazil and Australia, Argentina, and this picture was taken actually in Argentina. Now this ship here is loading soybean cake. And just to give you a feel for the efficiency and the competitiveness of this global industry, this ship is in an inland, this is a river in Rosario, this is the Rosario base there. Ship turns around, it's an 80,000 ton vessel, and it's going to offload that soybean meal in China at the same price per ton, transportation, that we would transport a ton of soybean meal, or for that matter, canola meal, from the Cape to the reef. So just to give you that scale feel, and if you look at that, we are standing behind us in this picture. That's where the big soybean meal plant is sitting, the crushing plant sitting. So the crushing plant's pumping it straight into the ship goes out. Bottom line, margins are tight, volumes are high, and comes back to productivity. So let's pull this now to South African case. What does this all mean for us? We still have our local consumption base. We are about 10,000 kilometers away from these markets. A lot of times that helps us. And if you're a net exporter of fruits, that could be a problem again. But let's just think about our consumers. Now this graph, what it tells you is where is the bulk of our consumers sitting? And what we are keeping a close eye on is what we refer to as class mobility. In other words, how fast is our population in South Africa, is the income increasing? Because, and you all know the story, the higher, when you move from income level, LSM, this is living standard measurements, 1 to 3, if you move into another class, 4 to 6, that gives you an average income level, let's say, of 3 to 4,000 Rand per month. You're moving into a bracket of about 6, 7, 8,000 Rand per month. So, and you all know what that implies for your basket of food items that you can afford. So this group here, 4 to 6, is the big group that really consumes. That's where you really start to consume poultry meat. You can start to consume a lot of vegetable oils, and we want to keep a close eye on that population, because the faster the growth rate in that population is, and we actually want all of them in the much higher brackets. We all know what the reality is in terms of unemployment, etc. But look at the rates. Now, this is a success story for South Africa. 2005 is the yellow bar. We've reduced the amount of people in South Africa living in absolute poverty by 47% from 2005 to 2010, and by a further 44% to 2015. Okay? The grant system has obviously played a big role in it. Social grants, etc. And you all know what our current account deficit looks like for government. So we're getting a lot more pressure on the system. So it's unlikely that we in the next 10 years will see the same amount of reduction And if we don't create enough jobs, we will not see this uptake. Look at this reduction we're already seeing. LSM 426, that grew by 17% in the last period of, let's say, 2005 to 2010, and then only by 5% up to 2015. So we are generally seeing a slowdown in people moving into higher income brackets. What does it really mean for us? Well, it affects the rate of growth in our feed or in our animal, in our meat consumption. Let's just take chickens. Chicken is the largest meat item consumed in South Africa. In fact, it's the largest item in our basket in South Africa is chicken meat, which is good news for the canola industry, for feed. Now that industry, the chicken consumption has grown, and that blue section is what we produce locally, and that orange section is what being imported. So yes, we are net importers of chicken meat. That consumption currently is lying at about 1.8 million tons of chicken meat. We consume about 800,000 tons of beef currently, okay? So chicken's about twice as much as beef, and we are importing a lot. This chicken consumption has grown by 60% over the last 10 years. And our projection is that over the next 10 years, by 2025, this chicken consumption will grow by 29%. So yes, the slow economic growth rate is affecting the rate of increase in meat consumption. This is not all over. This does not imply that it has to kick back right to our feed growth, the demand for feed demand, etc. What is in there is a lot of imports. Okay, so imported chicken meat. The question is, can we as South African agriculture and the whole industry, now I'm referring all the way back from the chicken producers down to the canola producers producing the feed, can we reduce the amount of imports coming in from chicken meat? So it's our responsibility to make the chickens more competitive and vice versa. The more competitive they are, the higher the uptake will be within the feed market. Very simple. Okay, so these are the numbers that are out there. We are publishing our outlook. 10-year outlook is coming out in August, so you can all pull it off from the baseline and from our website, and you can read some of those numbers in there. Just to, I'm going to skip this. I've made that point in the interest of time, because the bottom line is just here in terms of chicken. Our competitiveness globally is we're talking about a few cents per kilogram, not much, 70, 80, 90 cents per kilogram. Colleagues, that's how close these global competitive ratios are. Okay, so back to canola within the whole complex of field crops in South Africa. That is the largest area under production is obviously white maize, but it's rapidly declining. That's the area under white maize from 2000. It's been constantly coming down. Yellow maize is gaining pace as the feed demand is expanding. Soybeans are expanding fast. Sunflowers flat. This is wheat winter area, is relatively stable and gained a little bit over the last 4 or 5 years. And that red line, that's where canola sits. So our long-term projection is that canola area under production will end off at around about 150,000 hectares by 2025. And then with a constant winter rainfall, winter wheat area, that implies a little bit of an expansion in the total area under production in this part of the country. So if we get into the economics, what does this mean for an S&D? And this is these are two important figures. The one, I'll start off with soybeans, and then I'll do the same for canola, because soybeans, we've seen this trend for the last 5 or 6 years. And some of you might know these break-even points of how you think about a price. But essentially, price formation is very important. That red line, that's our domestic SAFEX price for soybeans. And look carefully what that price has done. The black line is the export parity price of soybeans. That implies if we would export soybeans, if we have a surplus of soybeans, we export it out of the market, that's the price that you would get. Import parity is obviously price that you have to pay to get soybeans into the country. So that's the band in a free market where your normal price, your local price can move in. Export parity, import parity. And you want to see that price moving in between. If we are closer to a shortfall, then this price moves to import parity.
If we're producing a surplus, we're sitting at export parity. Now look at soybean story. The moment when we started getting these crushing plants online, the local price started to move away from export parity because we created this additional crushing capacity, processing facility, and where's the soybean price now tending towards? Trading in the middle between import and export parity, and yes, in some periods closer to import parity, which is currently happening. So what's happening now? Soybean suddenly becomes a derived price from the oil and the cake. And what do the crushers do? They try to pitch their price, obviously, as close as they want to open up their margins. When do they open it up? If they don't have to pay that much for their beans or their canola, and they can get the revenue outside, but at the same time, they have to ensure that they get enough feedstock in to fill up their crushing plant. And that's exactly what's happening. So it's always a fine balance. If you're moving your feedstock towards import parity to fill up your crushing plant, obviously you're paying more for your raw material, but you get your throughput into the plant. So it's always, and this is the situations with soybeans now, same for canola. You have to weigh these up, these economics of crushing, and that's where the price is. And the projection, this is now for soybeans. That's a wonderful outlook, colleagues. A projection of soybeans running towards 2.2, 2.3 million ton market in terms of production, and the price sitting over the long run at the derived price of the oil and the cake. For canola, it's the same story. We saw the canola price sitting closer to export parity, and what has happened now? In the recent years, we've seen canola, and now this is the middle price. This is not the producer price. In other words, the price currently in Swellendam, moving closer and actually currently sitting closer at import parity of canola. So maybe above the derived value for the oil and the cake. And what's happening over the long run? Sitting at a long-term derived price for oil and cake of canola. Okay? And you can see that moving away from export parity into this space. And that's really where the price is supposed to be. At certain periods it will be higher, certain periods slightly lower. But on average you get this price that it's a derived price from the oil and the cake. And if it's not there, if it's lower, you'll not get the incentives for producers to plant. If it's higher, you'll see your expansion happening. And this is the balance that we want to see going forward. All right, so just if we want to bring it back to profitability, and these are hard numbers. As the speakers were referring to this morning, John and Rob, they were clearly saying the value of canola also in Australia as a rotational cropping, and that's really the value also that we've seen here in South Africa. It's not only the hard numbers in terms of gross margin per hectare, but also what does it mean for your rotational cropping, what does it mean for your follow-up crop, and all the benefits that we heard about this morning. What we've done here is taken actual numbers, and this is in participation with some of the co-ops. This was done for the Oeverberg area, so not in the Swartland area, but here you can see the comparison of how canola, wheat and barley have performed over the last 5 years, actual numbers, okay? And these are average actual numbers out of these representative or typical farms. 2010 to 2015, and there you can see that wheat and barley gross margins have been higher than canola. And you can, if you just look at the yields, the average yields that were achieved in the Southern Cape on wheat and on barley, they're exceptionally high. At 3.54 tons per hectare, and we had canola at around about 1.4, 1.5 tons per hectare. In fact, the average there was about 1.37 tons per hectare. Now look at the projection. This is 2016 to 18. If we would bump up that canola average yield to about 1.75, 1.8 tons per hectare, and we would take our medium-term average yields for wheat and barley at about 3.2, 3.1 tons per hectare, then suddenly your canola not only has a value in terms of a rotational crop, but also in terms of your gross margins. Then suddenly it starts to make sense. So again, these marginal increases in your yields, then quickly starts to, also you can see the economic benefits of the crop. And this is something that I just wanted to, this very busy graph. If you have it in front of you, if you go and read our book, it's actually nice to really go and compare what has happened. This is canola, and what we've done here is we want to see, is this achievable? So this 5 ton per hectare question. What in the world has happened, the different regions, in terms of growth rates? And here you can see, look at Australian growth rate. That's the average yield for the past 10 years of canola. And we've talked about those yields around about the same as ours. That's South Africa sitting there, average yields. But look at the growth rates in Australia. That little green diamond says how fast have yields grown on average in Australia over the last 10 years. They've grown about more than 6%. Okay? Now, where have our yields grown? Just under 4% per annum. And the question is now, with new technology, could we get our yield growth rate to about 6%? So that 4% there, colleagues, is going to take us on average, if we take our average yield at about 1.38 to 1.4 tons per hectare, that could take us to about 1.78 to 1.8 tons per hectare over the next 10 years. So we'll have to do better than about an average growth rate of 4% to get into the higher 1.8, 1.9 tons of yields. So that just gives you, and you can do this for all the other commodities, all the other regions. It's actually a nice slide to compare growth rates globally. Now, again, coming to the comparison and benchmarking, South Africa and both South Africa and Australia, this graph here, if you just look at the general message, it gives you average yields of canola, and this is what we're doing with a group called Agri-Benchmark globally, where we have 26 countries participating, and every year we go around and we collect the data, farm level data, with the same methodology. Okay, and we come back to these farms every year, and we do so. We have average yields for these typical farms across the globe for about, some of these farms are going now for 8 or 10 years. And here you can see the canola yields for South Africa and Australia. There we have like 3 farms, and 2 in Australia, 1 in South Africa. These are the European yields, and those are the Canadian farms sitting in the model. And you can obviously see those yields much higher. But now coming back to the question, is it all about yields? No, not really. It's about the costs to produce that ton of canola. That's really the sustainability issue. And this is again a comparison saying average canola direct costs and revenue. So in other words, now suddenly this whole picture changes. All these European farms that had the high yields also have high costs, okay, of establishing, of producing that ton of canola. So let's just compare South Africa there. Our costs about $213 per ton of canola to produce a ton of canola. If we look at Canada, $215 and $220. So the Canadians, although they have higher yields than ours, if we convert that and take cost of production to consideration, we have around about the same cost of production as per ton as Canada. Australia slightly lower. They're about $180 to $190 per ton production costs, and then South Africa at $213. So these are the kind of comparisons that one wants to do to see how efficient are you in allocating your resources or your inputs in producing that ton of canola. And colleagues, I'm going to conclude. This is my last graph, coming back to this whole drought story, and where we are at currently in South Africa. That shaded areas, again, is our outlook over the next 10 years. This is a story for agriculture over the last 10 years. Net farming income, and this is in real terms. So in other words, the farming sector, investing, if you've put your money into farming, you've been at the right place, okay? You've done really well. Real net farming income has increased. So yes, we've had these difficult cycles, ups and downs dramatically, but on average, our real net farming income, if you just look at the trend, has increased tremendously over the last 10 years. It's been wonderful to be in the farming business, okay, despite of all the worries that we're having. Now, what's going to happen going forward? That period there, we can see a recovery, 2016-17, coming out of the drought. There's a recovery, but then we're going to get into this period, and that's the question. So these are assumptions based on exchange rate, economic growth rate. Only from 2019-20 we see this economy getting out of the slow growth period. And you see this running through all the cycles, running through all the various industries, 2-3 years of tough times with slow economic growth rate, and it also depends on our exchange rate. Just have a careful look at what the exchange rate is doing now. We were actually anticipating that strengthening coming only next year. So it's starting a little bit earlier now, and that is affecting our gross revenue for agriculture, or potentially for this summer crop. So keep an eye also on your winter prices. And really, I'm not here to say what the exchange rate's going to do. It's a big question around it. But generally, South Africa will have to catch up with what's happening out there in the world in terms of lower global commodity prices. So if the exchange rate remains weak, we're going to get it feeding through in our input costs. If the exchange rate turns around, it's going to affect our commodity output prices. Basically, it boils down to the same story. Productivity growth, stay on the productivity curve, and that's the only way that we'll do this long-run sustainability. But the growth is still there, colleagues. The growth is still there. If you look in the food demand growing, if you look at the globally and regionally and locally. So it's not going to disappear. We've got strong growth growing. It's just we need to drive those productivity factors constantly. Thank you very much.